You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, so crazy week in the markets, and I might say that at every single podcast over the last 5 months. But with that said, everything was focused on the CPI numbers. All the analysts thought that inflation would be trending the right way. I don't know if people are just praying for it or if they just keep saying those words that it will eventually come true, that inflation has spiked and that we're at a precipice and that it's going to start coming down. And as a lot of economists say, as far as inflation is concerned, the direction that it's going is almost more important than the actual numbers. We would like to see a big fall off in inflation, but just the fact that it's showing signs that it's waning would have been great. Guess what? It wasn't. Numbers came out poorly, even the core CPI numbers, which the Fed really takes a peek at, though everything was not good, and the markets reacted accordingly. Okay, so now last week we decided to get bearish, and I don't see any reason why we wouldn't continue to be bearish. So last week we just looked at an overall market trade in the S&P 500 index and talked a lot about doing butterflies when I'm bearish in the S&P 500 index. There's a simple little trade that we like to do where we just buy some out-of-the-money puts and organize a butterfly, and then if the market goes against us, we roll into a short put spread. It's just a common way to speculate on a short-term move in the marketplace. A lot of things have to do with seasonality. September was fooling us for quite a while. Actually, since the beginning of September, I actually ran the numbers going up into the CPI announcement, which was on the open before the open on Tuesday, and just looking at the numbers in the SPX, basically from the 1st up until September 12th, Monday, the market was up over 5% in September, which is so far so good as far as September is concerned. But then, of course, we get blindsided by CPI and the market gave up a good chunk of that 5%. So today we are taping Options Playbook Radio. It is Wednesday, September 14th. The markets are closed. And we'll look at last week's trade, which was a short-term, very speculative trade. And as always here on Options Playbook Radio, where nothing's meant to be a recommendation. We're just trying to take market conditions and apply strategies based off of those conditions. It's more about pricing than trying to mold a strategy to match whatever underlying we're looking at. This week we were looking at the SPX, had a little bit to do with the increase in implied volatility in the VIX index, and that's part of the reason butterflies are cheap in the S&P 500 index when the VIX is up above 25%, and that's where they were at, as opposed to the VIX maybe being at 15%. The butterfly is a little bit more expensive, and it's just that simple. If you put a butterfly on, you're correct on your forecast. You want implied volatilities to go down. When you're putting the trade on, you want implied volatilities to be high. That's the best circumstance. And the main reason why that is that if you are correct on your forecast, you want the stock to go to your middle strike. And guess what? You are short 2 option contracts at that middle strike. And in order to make the maximum, you need time decay to whittle away at those 2 option contracts, because they're at the money option contracts and you would have to buy them back to close them. Or another way to benefit is if implied volatility went down and took away some of the premium on those short options inside your butterfly. So that's the moral to the story. All right. Well, and that trade turned out just fine. If you go back to September 2nd, which is a Friday, and you look at the trade that we put on, we went below the market when we set it up. We're using put options, and we bought the 39.75 put, sold 2 of the 39.55 puts, and bought 1 of the 39.35 puts in last week's podcast. We paid $190 for it, or $190 plus commission for every 1x2x1 butterfly. Maximum risk is $190. The width of the butterfly was 20 points, so the maximum upside would be 20 points, or $2,000 minus the $190 plus commission to put on that trade. All right, so that's the gist of it, the break evens. And the market on Friday, which was September 2nd, came in and it opened at 39.94. So you're like, oh, dang, I didn't make it. It didn't land within the strikes of my butterfly. But before you know it, the market started going down, and it actually closed outside of the range of the butterfly at 39.24. So it went from 39.94 down to 39.24. So ample opportunity to get out in the middle. And that's what you want with the butterfly. You want to be as close to expiration as possible and have the butterfly hit your short strike. So at some point in time on Friday, it did. You would have closed it out. You should have had a profit on it. Now, I said the maximum that the butterfly could trade for is $20, but we never are looking for the home run. If it hits the short strike, you're going to get out. And if you pay $190 for it and you sell it for $4, that's a great trade. So don't get frustrated, especially in the SPX, if it's not paying you quick enough. You literally have to be right at expiration for the at-the-money option contracts to basically decay in the S&P 500 index, just because it's a large value index, and volatility overall. Right now volatilities are pretty high, so you really needed to be right at the money in order to get that maximum on that trade. My attitude is always, if I'm on the Friday of expiration on a butterfly and it hits the short strike, I just get out. Just close it, move on. If it's not as much as I thought it should have been, oh well. Sometimes it might be more. You might get a little bit of a decrease in implied volatility, and you're happier than you thought. But anytime that I can double on a butterfly, I pay $190 for it, and I can sell it for $380. That's a great trade overall. All right. So this week, let's stay bearish. On the stock play of the day for Ally Invest, which we do on the Ally YouTube channel every Tuesday at noon Eastern time, I looked at just getting bearish in general on tech stocks. So we used the QQQ and we did a long put spread. So I'm going to deviate from that. And just some news came out on Meta this week, or i.e. Facebook, and I'll probably use them interchangeably here on the podcast, that viewership on a month-over-month basis is actually decreased. So even though Meta still is at a decent valuation, there's losing some eyes, some prying eyes on some of their content, and the stock reacted accordingly. That is just in general not good news about a social media platform. You want as many people looking at it as possible, and you're hoping to increase that stuff, those number of views or on a month-over-month basis. So Meta is down 166 on the day today. It's trading at 151.47. So based off of that, and that's mainly off of that news, market was okay today and kind of held its own. It was a little wishy-washy on which way that it really wanted to go. So with that said, the fact that we did have an update in the market and we did have Meta actually going down, that's obviously not good news, and it's been really beat up since the beginning of the year. So why don't we jump on? Let's jump on board and stay bearish. We are still in September, so I'm going to do a trade that's going to take you out to September, and we're just dealing with the seasonality. Going over time, September has been one of the worst performing months in the marketplace now, and there's nobody that's ever been able to come up with a reason why September seems to be the worst performing month in the calendar year, but year over year it seems to do that. So there has been positive months in September. We started out the month positive, but let's just stick with the theme that going into October, we're going to still be a little bit bearish on the marketplace. Once again, not meant to be a recommendation. This is a very speculative type trade, but I'm going to take the market conditions, look at a strategy that I might consider based off of high volatility and just a fairly weak marketplace, and in particular in the tech stocks, right? That is one area that has really struggled, and mega cap tech has not done well. Even Apple recently has had some weakness in the stock. It had a real strong July, and Apple is giving some back now. So let's look at Meta. We're going to go short term. We're going to go out until the We're going to go out until the September 30th expiration. So right now we are taping. We are on September 14th. Expiration date for these Meta options is going to be September 30th. Stock is at 151.47. We're going to straddle the market and go about 10 points wide. The market right now being a little bit, I'd like it right at 150. Let's put it that way. It's a little bit higher than 150, and it's right in between the strikes. You could either look at it as straddling the 150 level or straddling the 150-250 level. I'm going to say 150. We're going to buy the 155 strike put, and at the same time sell the 145 strike put. The strategy is a long put spread. We're 10 points wide. That's the maximum that it could trade for. The net debit that we pay for this trade is going to be our total risk of the trade. So on a 10-point wide spread where we're straddling the market, we're going to be paying a net debit of $4.40 if we can execute this trade at the midpoint, and we can't forget to add in commissions. All right. So if you look at this and you do execute at that trade, our break-even point would be 155 minus the 440 that we would pay for that, or 150.60. So we have a little bit more time premium that we bought than we sold. So the market does have to come down a little bit in order for us to break even on that trade. So our break even is 150.60 minus 151.47 means that we're paying about 87 cents worth of time premium. So we would need the market to go down a little bit in order for us to get to the break even. But by straddling where the stock is at, our hope is that our break even on our long put spread will be fairly close to where the market is at right now. Ideally, I would like to buy just as much time premium as I'm selling. And when you straddle the marketplace, equidistant in or out of the money usually has the same time premium in the option contracts. So in this case, we didn't quite get that to a point where we're paying 0 time premium, but 87 cents isn't bad. So let's highlight the trade, and then we'll just leave it there. We have Meta. Right now we're taping Options Playbook Radio on Wednesday, September 14th. The markets are closed. Meta closed at 151.47, down $1.66 on the day. We're going to buy the September 30th 155 strike put, and at the same time sell the September 30th 145 strike put. Our net debit is $4.40 if we can fill at the midpoint. That means for every 1-by-1 spread, we're going to have $440 worth of risk plus commissions on that trade. Maximum upside would be the width of the spread, which is $10 minus that $440, or $5.60, or $560 less commission for every 1-by-1 spread that we do. All right. Well, that's it for this episode of Options Playbook Radio. If you have any questions you'd like me to try to answer, just please email them to me directly at theoptionsguy@invest.ally.com. If you'd like to know more about the events that I talked about on today's podcast, like Stock Play of the Day, please follow me on Twitter. My handle is @BrianOverby. And hopefully we'll see you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.